All right, let's dive into CubeSmart. We're talking about the third largest self-storage REIT in the United States. And right now, they're sitting at a fascinating crossroads. You know, the whole post-pandemic boom, that's over. It's normalized. And now, a new cycle is kicking off. So the question for us isn't if the cycle is going to turn, but what that turn actually means for the bottom line. And that brings us to the core question we're trying to answer here. Is CubeSmart a genuinely high-quality company that's just hit a cyclical low, making this a prime value opportunity? Or are the headwinds, the frozen housing market, those stubbornly high interest rates, are they signs of a classic value trap? Getting that right is the entire game. So here's how we're going to tackle it. A simple 5-step framework. First, we'll lay out the investment thesis. Then we'll put it to the test and analyze their competitive moat. After that, we'll dig into the numbers to see if the story holds water. Then we'll look at where future growth is going to come from. And finally, we'll land on a verdict.
Okay, let's start with the thesis. The whole investment case for CubeSmart it boils down to one big idea. Their strategy to build what you could call an urban fortress. They focus their portfolio almost exclusively in the densest, hardest to build in markets in the entire country.
So the pitch is this. You're getting a top-tier defensive business run by a sharp management team at a price that reflects temporary, cyclical pain, not some permanent damage to the business itself. That's the core argument.
But, a good story is one thing. How does that translate into a real competitive advantage, a moat? In a business like self-storage, which can feel pretty commoditized, having a durable moat is everything. So the question is CubeSmart's advantage for real? Is it defensible? Now check this out. This one number tells a huge part of the story. In the third quarter of 2025, while a lot of other markets were soft, CubeSmart's New York City portfolio jacked up rents by 7.4% year over year. That's not a random fluke. That is the direct result of their strategy paying off. And here's why that happened. This is where their pricing power comes from. New York City got rid of this tax program called ICAP, and in doing so, they basically made it financially impossible to build new self-storage facilities. So CubeSmart is now operating behind this regulatory wall that new competitors can't get over. The supply spigot has been turned off. And this quote from the source material really just nails our approach, right? We're not chasing narratives. We're looking for real, defensible structures that protect cash flow. And what's happening in New York City is a textbook example of exactly that. So the moat story is powerful, no doubt. But a great moat doesn't mean much if it doesn't show up in the financial performance. So now it's time to run the numbers and see if the reality actually matches the story. Okay, let's just address the elephant in the room right away. That negative spread between ROIC and WACC, right now, their return on invested capital is running behind their cost of capital. Plain and simple, that means for the moment, they're destroying a tiny bit of value. Now, this is driven by high borrowing costs and some big recent acquisitions that aren't fully stabilized yet. It's a critical headwind, but the bull case says it's a temporary one. Now, if we look at how they stack up against their peers in Q3, a couple of things really pop out. First, their occupancy at 89% is lower than Public Storage and Extra Space. That tells you they're probably pushing for higher rental rates instead of just filling up units at any cost. But the second point, that's where they really shine, expense control. And this chart just makes it crystal clear. I mean, look at this. In this inflationary world, Extra Space saw expenses shoot up 6%. CubeSmart, they held the line at just 0.3% growth. That is phenomenal operational execution. We're talking successful property tax appeals, smart insurance management. It's a huge, huge differentiator. All right, so we've got the current financial picture. Now let's pivot and look at the future. I mean, a defensive moat and tight cost control are fantastic, but you need clear growth drivers for this to be a great investment. So what's the plan to create value from here? This number right here, this is probably the most important green shoot for the bulls. In Q3 of 2025, their move-in rates finally turned positive year over year. That's the first time that's happened since early 2022. It's a huge signal that the industry's race to the bottom on pricing is likely over, and some of that pricing power is starting to creep back in. So beyond that organic growth, CubeSmart has this really smart way they allocate capital. Instead of taking on all the risk of building something from the ground up, they use joint ventures. It's like a try-before-you-buy model. They take a small piece, they earn fees to manage the property through its riskiest phase, and then, only when the asset is stable and proven, they swoop in and buy out their partner. It's a brilliant, de-risked way to grow. And this isn't just a theory. We just saw this whole strategy play out in 2025 with the HVP IV acquisition. They dropped over $450 million to take full ownership of 28 properties that they already knew inside and out because they were already managing them. That is disciplined growth, not speculative.
And look, they can pull off these kinds of moves because their balance sheet is a fortress. We're talking very conservative leverage at 4.7 times net debt to EBITDA, and their debt is almost all fixed rate, which insulates them from rate shocks. Honestly, locking in 10-year debt at just over 5% in the 2025 environment, that was a very, very sharp move.
Okay, we've gone through the thesis, the moat, the numbers, the growth plan. Now it's time to bring it all home, look at the valuation, and make a call on the risk versus the reward. So, from a valuation standpoint, the stock's trading around 15 times forward funds from operations. Now, historically, it's been more in the 18 to 20 times range. So, you're definitely getting it at a meaningful discount. That tells you the market is basically assuming the current weakness is going to last forever, which creates an opportunity if you think it won't. So what could a base case return look like? Well, you start with a really solid 5.5% dividend yield, which is a great floor. Then you pencil in, let's say, a conservative 3% FFO growth each year as things normalize. And maybe you assume just a little bit of multiple expansion. You add all that up, and you're looking at a potential annual return in the high single digits. Pretty compelling.
So really, the whole debate boils down to this. The bulls are saying that urban moat and the lack of new supply are going to let CubeSmart just drive rents higher. The bears, they're worried that sticky inflation on the expense side, combined with flat consumer demand, is just going to keep squeezing margins, no matter how good their moat is.
After weighing everything, the conclusion from the source material is pretty clear. It's a good business, run by good managers, and right now, it's available at what looks like a reasonable price. It's that simple.
But let's end on a forward-looking question. Because if those move-in rates are truly telling us the worst is over, then maybe the main risk is about to shift. Maybe the danger isn't the market anymore. Maybe the real risk as we head into 2026 is the temptation for management to get aggressive and start overpaying for acquisitions in a hotter market. That's the new thing to watch.